Hi traders, welcome to step 3 of your trading journey, and today let's discuss basic smart money concepts and supply and demand zones. So in the beginning I wanted just barely touch Wyckoff concepts, again just the very surface, okay? So there was this trader, Richard Wyckoff, and he proposed a really nice idea. He said, when you think about the market, try to imagine, okay, just try to imagine that whole market is manipulated by one man, okay? This man knows everything about the market, everything about any kind of fundamentals, and he can use, and he even can manipulate the price a bit, and overall this complete knowledge about everything, every aspect of the market gives him like almost 100% almost 100% knowledge about where the market will go over long term and how the market participants will perceive prices. But that's not enough for him, and he wants to be even in more profit. Yeah, and he called this man the composite man. Again, it's very abstract. Okay, of course it's not like one man sitting sitting on the buttons of this computer and manipulated the market. It's abstract entity, or we can call like strong hands and weak hands. So for today, what we want to know about all of this is they want profit from the market, okay? So, but here is the problem. They have so much money that when, for instance, they sell here somewhere and they want like to exit the position in profit here, for instance, or if it were an uptrend, they entered here and want to exit here in profit, they have so much money that they can just push, market can go like this, okay? Because it's just impossible because of the nature of the market. Because if you want like to buy, you need sellers. If you want to sell, you need buyers, and so on. And for this, this composite man, again, now we are like talking very simplistically, but it's for the purpose of this video and these basic steps. So what they did is, and what they are doing actually, is when overall market is moving down, they are performing moves up to manipulate the market, manipulate the weak side of the market, the side that will be in drawdown, the side orders of which will be used to fulfill the main orders of the composite man, of the smart money, of the institutions that are in profit. Okay, all the same namings. So you see, market is pushing up, so we have a lot of buyers to which strong hands sell then and push the market down. Again, they push the market up and then push it down. They push it up, it consolidates, they push down, it comes back in the zone and pushes down again. It goes up. So based on this theory, every move up is some kind of manipulation. Okay, and here is the problem for the composite man. So it's like a problem and a solution at the same time. Why? Because when they push the market up, they also participate in the market and they have their buy orders there. And when then the move down happens, they will have these orders, these buy orders, in negative. Okay, they will have it in negative here. And now they want to come back to this zone. They want to come back to this zone and close their orders at break even before continuation down. And again, just going a bit further, they are not, this composite man entity, they are not trading like we, okay? It's like more like a computer trading or algorithmic approach, yeah, because they are operating at different time frames and at different positions, like millions of positions headed in different directions in the same time, but overall they are heading bearish, for instance. So they are selling and buying at every time frame, every position, like every second. So on the seconds time frame and on the monthly time frame, they are operating. Okay, so it's like a very complex thing, but what we need for our trading is just to find where they are involved and to understand where the market is going. So this is where it all comes from. But let's go back again here. So they had this manipulative push, and then they are in drawdown. So they come back, close at break even, and then they are ready to push the market lower. Then again, manipulative push up, but you see the market is not moving like I'm drawing here. And here, this is why it's so complex. The market, if you trace the price, it will move something like this. So it will create a lot of structures, like outside structure, inside structure, a lot of manipulation, spikes up, stop hunts, and so on. It's all happening because many participants, they are involved in the market on in different ways, and composite man uses this to create these liquidity pools and so on, and then use it to push market where it wants it to go. So, but the basic idea is this: before any kind of push down, there will be some kind of push up, and this push up can be used as our supply or demand zones, which today we will have like a big complete zones. So for instance, this is a push up which broke here. Okay, we will say let's do this is a push up which broke here. So this is like a huge manipulative zone which broke here. And then what can we expect? We can expect that price comes back into this zone, and somewhere in the zone it will turn back and go in the direction of the break. Now again, this push up, we can extend it and find where it breaks. So this is a push up. Now everything is manipulative. It breaks, comes back in the zone, and continues down. Again, this is a push up. So you see, this is a move up and then push down, and then push down. Again, price comes back in the zone, mitigates it. So this action, when price comes back to the supply or demand zone, we call it mitigation. So it means that smart money is closing their orders at break even there before continuation. Again, you see, push up, now inside manipulative price action here. So this is all supply zone for this market. Breaks here. Now we expect the market to come somewhere here, and I will come back to more specific zones and continue lower. Okay, and you can continue doing it by yourself. So this is a way how we can see big supply or demand zones. Why? And by the way, how do you think this price action will look, for instance, on higher time frames? See, let's go on weekly. See, on weekly it's just like 4 candles, and if we go on 2 weeks, it's like 2 candles, and on monthly, you see, it's just 1 candle before the push down. So maybe you've heard before this idea of candle, a banker's candle, yeah, or institutional candle, is this last down candle before the move up. But what we need to understand that any candle from fractal perspective will be some kind of move. So this one candle, which looks like one down push, in fact, on lower time frames, it will look like this. So that's what we need to understand about supply and demand zones. So you see, it's just a different perspective. So even the zone is big, we understand that this is like a candle. So this is a candle on monthly, but we understand that it's all happening inside one candle on higher time frames. So what I'm doing now is just showing a bit different perspectives. Okay, but of course you can trade something like this. So you have this supply and demand zone, and you know the price is mitigating. You can place your stop loss there, your entry somewhere here, and you can trade it. But the problem with such approach is that the risk to reward will be like really small, and your stop loss will be like too big. It's not necessary to have such a big stop loss. That's why we can refine the supply and demand zones. How can we do it? We can find the last unmitigated portion of price action. So why should we do it? So for instance, let's see here. We had some price action. We had break of structure, and here you see we have a pullback, and now we have a break of structure here. So now we have a range. So we have this price expansion, and as you see, before this move happened, we had this move up. So this is a move up before move down, and now this move up is our supply zone. But what can we see is that there is this portion, this last up candle with imbalance below. So this is our refined zone. This is the last unmitigated portion of price action. So what it means in connection to what I said before. Remember, I said that when a manipulation happens, they have these orders in negative. And so if they want to continue the move down, and they will come back to this zone and mitigate it, they don't want to go above this zone, because it just does not make any sense from the smart money perspective. So this up move is the last manipulation. So when they come here, they are closing all the orders they need, and then they continue the push. So this is like the basic idea of this. Same thing here. You see break of structure, manipulative move up, they come back here and continues the push. And if they do not want to do it, they will break the zone, and that's it, and the trade is down. But we can use this this assumption that the structure is holding and supply and demand zones are holding. So we can use it to have better risk to reward. So for instance, like this, and of course we will discuss more details in the future. Yeah, so what is unmitigated zone? Unmitigated zone is the zone that has imbalance. For instance, this is the last move up. So when you have a candle and then a wick above, you can understand that the move was happening from here to here. I will come back to it later, but overall you have this move up, and you see when the price was leaving this zone, this manipulative zone, it pushed in one direction, so never came back to this zone. This is called an imbalance, and this is unmitigated zone. On the contrary, you see this price action. It all filled with wicks. So what it means? It means that there was some kind of move. For instance, this one. So there was a move up, and then move down here. You see, it moved down first with imbalance, but then came back into the zone. So what it means from smart money perspective, it means that they came back to the zone immediately, and possibly they closed all the orders they need. We don't know for sure, and the zone can have multiple touches. multiple touches before it goes. So they close some portion here, they close some portion here, then came back lower and closed more here, and they could come back even higher, to close more orders before pushing down. But what it also means is that if they already had a zone and they already came back into the zone to mitigate some orders, then maybe they closed all the orders, and now when they will come back to the zone, it means that they have no reason to be so far in the zone, and it probably means that they will even continue further to mitigate more zones, maybe from higher time frames. Yeah. So that's why these zones with imbalance are more high probability, and for now we will use only unmitigated zones for our trading and for our trading plans. Yeah, so this is like very basic information. Hope it's not too confusing, and here is your homework. You take any kind of market and you try, so first we abstract a bit from the structure we discussed before, and we see it like more freely now for this first part. And you say, okay, overall the market is moving down, so I need to find my big supply zones, my big manipulation zones. And you say, so this was a move up, so this is a big supply zone. And where did it break? And it breaks with body close, you see? So we have a break, and now this area is a huge supply zone, which breaks again here. So you see a break, mitigation. So this is a break, this is a mitigation, this is a continuation. And now, because of that, you can mark up this zone, this big zone. So your first task is to mark up big supply or demand zone. So you see big manipulative move up, break. So manipulative move up, break, and come back to mitigate inside this zone before pushing down. Again, manipulative move up, break here, come back to mitigate some portion of it, go down. Manipulative move up, break, comes again, breaks, comes again to the same zone, goes, and as you see, the pattern is like this. So we have a zone, a zone, a zone, and this is what you should find first. And then the second task, so let me mark up maybe a different kind of market. So maybe for GU. So the market overall is moving up. That's why we will find manipulative down moves before moving up. So the market pushed down before break up. So this is a huge demand zone, and you see market never violated it, and then it created a new push down. And for this task you can be more subjective, but it has to make some sense. So again, this is like a break, mitigation, and a break, and then market comes down, or you can say, if you start from here, like a move down, or you can say this huge move down before break up. Same way, you see. So this is we will not use this directly, so this can be like real subjective, but the whole idea is that we have this huge move down before move up, and now this area will become, you see, huge move down before move up. This area became a demand zone which held and continued to move. And by the way, if you will go on monthly, you will see that this is just down candle before move up. You see, just down candle before move up, and now this is our demand zone. So this is your first task, to mark up the chart like this with these big huge zones. And then your second task is go again to any time frame and mark up the charts with the structural rules as we discussed in the first video. So I will do it quickly now. So we had some kind of a break. So this is a move down, and now you need to find the last unmitigated portion of price action. So again, for now it can be subjective, but just pay attention that if you mark up something like this, let me zoom in. You need to understand that this is so if you have this break of structure, and this is your impulse, if you mark up something like this, so this candle like a move up before move down, you see it's already mitigated before the break, so it's an incorrect zone. Instead, you can mark this zone. So this will be a refined supply zone with imbalance. Okay, and you need to find the last one. So you will have some unmitigated portions of price action here with this imbalance, or here, but you need to find the very last one, and I will explain later why. For now, just do it mechanically. And then you need to notice that you see this zone like first had some reaction, but then became broke, and now you have a new range, and you need to find unmitigated portion of price action. For this range is this one, this candle. You see, you have a down move, and then this imbalance and a break. So this zone didn't hold again, and we have a break of structure here with this low, and we have this unmitigated portion of price action, this one. See this up candle before the down candle. So now if the price would come back here, we would expect some bearish reaction, but the price never came all the way there. It's okay, and we had this new break and this zone which was mitigated, so we just skip it. Of course, there were some unmitigated portions, but for now we need to understand that this is the up move which was mitigated here right away, so we don't count it as our unmitigated zone. I will tell later how to trade something like this. And as you see, this one held, so we had a zone, even if for now it was mitigated here, and we had this technical break, and if you see, there was again no unmitigated zone because this is an up move and price already came here, so no imbalance on this time frame. But as you see, we had some unmitigated portions in different places. And by the way, sorry, so if you have this if you have something like this, so you have a break of structure, and then your like most obvious part is mitigated, then maybe you have, so this is mitigated, this is mitigated, maybe there was some up candle here, yeah, and then you can say, okay, this is unmitigated, my last unmitigated portion of price. So let me find a quick example for this. So yeah, for instance, here we had this huge move, and we had this break of structure. This is the protected high, this is the low, and let's imagine that everything is mitigated here. In this case, you would say my last unmitigated portion is this one, because above everything is mitigated. Yeah, because as you see, you have this up candle which also is unmitigated. So in this case is this one, and this candle is already mitigated. You see, it went below and went right above, so we assume that if they closed the positions, they could close like a big portion of it, and we don't want to use it. So this is the second task, is mark up break of structures like we did before with the pullback rule, with break of structure rule, and inside this price expansion find the last unmitigated portions of price action. Okay, like this one, or if this range, so this one, and then you have this new range. And by the way, you see inside on this range you have only this up move that is unmitigated, and that worked perfectly. So you have this range, mitigation, and continuation. Okay, let me know if you have any questions, because I think this session can be somewhat confusing, and I will wait 2 parts of your homework. Bye.